J.W. Nigerian and Leo Manriquez, and I'm with the Commercial Real Estate Professional Investors Group, and Leonard is with Commercial Real Estate Distressed Assets Association. We're both in Los Angeles, and today we're at the GreenPearl Real Estate Distress Summit, and we're talking to Raymond Lowe, Managing Director of Wells Fargo Bank.
Yes, I run commercial real estate lending in our real estate banking group in downtown Los Angeles.
Great. Listen, great to have you. Thanks for taking the time. I know you spoke today. Since we're at a distressed assets real estate forum or summit, I'm guessing you're speaking about distressed assets?
The how to capitalize distressed asset acquisitions.
Okay.
And my office in particular has been doing quite a bit of that. In 2010, we provided, my office did something on the order of $700–800 million of financings for acquisition of distressed assets.
Okay. And when you say for the acquisition, is this for the bank's portfolio?
Yes, we're a balance sheet lender.
Okay.
So everything that my office does is an earning balance sheet asset for Wells Fargo.
Okay, and did you buy these from the owners, or did you buy it from through a fund or a holding?
What we did, no, we're providing acquisition financing.
Okay.
So that ranges from acquisition financing for folks to buy partially leased buildings, empty buildings.
Okay.
Oftentimes ORE or short sales on the buy side.
Okay.
We do that, recourse and non-recourse. We also finance the acquisition of subperforming and non-performing notes. We've done that on small scale, 2, 3, 4 assets at a time, and ranging up to a few hundred assets at a time.
Okay. So, and everybody hears there's no such thing as a non-recourse loan anymore, but you just mentioned it, so let me bring it up. How does that work?
Wells Fargo actually has had a very robust on-balance sheet commercial real estate non-recourse lending practice for about 16 years. Mm-hmm.
And I thought that was after the table after about the end of 2008.
Well, what happened in 2008 with the purchase of Wachovia Bank, we had some internal reorganization. We basically merged our recourse and our non-recourse lending groups together.
Okay.
And I was with the non-recourse group. Now I'm managing 2 offices, one of each. Mm-hmm. But we're still doing what we did before, which was providing non-recourse balance sheet loans to what typically a typical non-recourse borrower is either a high net worth individual who just chooses not to sign a guarantee and would rather pay the higher price to get non-recourse,
right.
Or more typically a joint venture between a investor developer and a private equity fund.
Right.
And the 90-10 joint venture structure usually results in them wanting a non-recourse loan.
Okay. And where do your loans start at?
Size-wise,
mm-hmm.
Generally around $10 million.
Mm-hmm. And up.
And up, and no real
ceiling.
Yeah. Smallest loan we originated last year out of my office was $6 million.
Okay.
The largest was $500 million.
Okay. And you said something interesting earlier. You did more loans in 2010?
Our group nationwide really set records for new origination in 2010.
And because we've been hearing that it was very dead last year.
Well, we never pulled back from the markets deliberately. Mm-hmm. There's clearly less transaction volume going around. Okay. And in 2009, that resulted in not very many borrowers coming to us looking for loans. Mm-hmm. A lot more of that in 2010, and that's what resulted. The combination of picking up a transaction volume, and for most of 2010, for many asset classes, really anything other than a trophy, cash-flowing, high-quality asset, of which there were only a handful of trades last year. But anything of lesser quality than that, there is, for most of 2010, there's very little competition for us. And so we picked up a lot of new customers in 2010 where their traditional financing sources, a fund, a bank, just weren't there for them.
Mm-hmm. Well, we hear so many stories out there about the banks and, not having incentives to let REOs go and properties go, and that they're holding a lot of stuff. Do you find that to be true, or do you find that that's more?
That's absolutely true.
Okay.
That was true through most of 2008, all of 2009, and half of 2010, which is a long time.
Yeah, it is a long time. So are things turning around, and why would that be?
Two things have happened, and the selling of distressed assets by banks really, there was a significant change in the summer of 2010. And for the first time, there were some large-scale portfolios of bad loans sold directly by banks to large-scale investors.
Okay.
Why didn't that happen earlier?
Right.
Because they had the assets earlier, and it was a combination of three factors. One is earlier in the cycle, the regulators for a lot of these banks, especially the smaller ones, were quite frankly very lax with them, and deliberately so, not wanting to put so much pressure on the bank that they would go under. So that was a policy decision by our administration.
Sure. You would have to write off huge losses, which is not great.
And that would kill the bank.
Yeah.
Second thing is by summer of 2010, most banks had several quarters of positive earnings, and that built up their capital cushions to the point where they could now afford to sell some assets, which on every sale they're going to generally take a loss even greater than that which they have already written off. So they rose their capital, and unless they built up a cushion, they couldn't afford to sell the assets.
Right.
Now they can, starting summer 2010. And third, for those banks which are unhealthy but survivors, combination of increasing pressure from the regulators to raise their capital limits, they find that going out into the capital markets, if you have a big book of distressed assets, investors don't trust the bank, even though it's profitable, to invest in it. So there's marketplace pressure that says, where the marketplace is saying, if you sell those, get rid of those distressed assets off your books so that I don't have to worry about them blowing up, then I will invest in your bank.
But the banks at one time, I don't know if that's changed, didn't have to show those assets. They kind of put them aside.
No, they're there.
Yeah.
They're there. They have been written down or written off, but they're still there.
Right.
And the problem is, you take a $30 million loan, or let's say a $10 million loan, and you write it down to $7 million, and you think that's on the basis of an appraisal. Probably it says the property's only worth, $7.2 million. But that's just an appraisal. It could be that the asset's actually only worth 5 or 4. And when you go out in the marketplace to sell that loan, and they tell you that it's only worth 4, if you sell that loan, you're going to take an additional $3 million loss.
Right.
And that it will erode your capital.
Right.
So
are you going, when you're putting out properties into the pipeline, which ones does it behoove you to put out? The better ones or the not so good ones?
If you are a bank selling distressed assets, your behavior will be depending on which group you're in. And there's two groups. It's not big and small banks. It's healthy and unhealthy banks.
Okay.
The healthy banks, and we all have large numbers of distressed assets, just about all, and we do as well. The healthy banks will approach dispositions on a case-by-case basis, maximizing the value.
Okay.
Because even if you've written off $5 million of a $10 million loan, if you sell it for $7, you're going to take $2 million of your previously written off reserve, and you're going to get a recovery, which is income. So the healthy banks are just about maximizing value, and in many, many cases, you will maximize value by not selling today, but selling later.
Right.
Now, if you're an unhealthy bank, your decision to sell will be driven by things other than just sheer asset value. It will be driven by the fact that they're getting this regulatory and marketplace pressure, and they got to sell. They got to sell by quarter end. They got to show progress. And when you sell in bulk and when you sell quickly, you will probably be leaving money on the table for the guy who buys it. We were involved in one transaction where there was some pretty good loans sold at pretty big discounts, simply because if they had not been sold quickly, that bank was going to be shut down.
How about notes? Is it better for the bank to go note-wise, or get rid of the asset entirely?
Once again, healthy banks will say, we'll just do the analysis. At Wells Fargo, our distressed asset, our guys sold a lot of notes last year because the marketplace for buying those notes got so heated that people were willing to pay for the note the present value of the future ORE. So our guys will say, let's say if we foreclose and then sell the property later in the future, we'll get this much money. And if I discount that into the present, somebody's willing to pay that to me today for the note. So of course you'd sell the note.
Sure. And I'm surprised it was still such a frenzy, but
well, there's a lot of people with money who are looking for deals, and because especially the medium and smaller players have seen very little transaction volume, they're impatient.
Okay, let me ask you this. Have we seen the bottom? I mean, we got CMBS stuff coming up till 2015. We still have unemployment issues. Where are we at?
My biggest fear about what could fundamentally change it is continued anemic job growth or no job growth, resulting in structural unemployment and putting us at risk for actually a deflationary cycle. The Fed seems to be managing that well. So if we set that possibility aside, we have seen the end of